Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is a personal financial advisor. He is the chief executive. He is not. He's very important, though. He's incredibly important. I'm just so used to talking to chief executives. Occasionally give the little people a turn. Warren is an executive director at Galileo Capital. You still there?
I am.
Okay, just checking. After that abuse. Good, the bad, the ugly. I mean, is there even a neutral when it comes to debt? Not all debt is bad. Some debt is good, but all debt should be paid off as quickly as possible. Talk to me about this debt gremlin, if you like.
So I think it's probably the question I answer most when I talk to groups of people about money. And somewhere along the line they'll say it's all good and well that you talk about investing. My problem is not investing. My problem is that I have a debt issue and I can't solve the debt problem. So what else should I be doing, with my investments then? And so it's probably, I would say, from the survey of Warren Ingram's kind of experience rather than some marketing company doing a survey, I think it's possibly the biggest issue that we face in the whole personal finance space. And it's true that, any textbook on financial planning will tell you that, you need to be debt free and, you need to build up your savings and get going. But the reality is that for most of us, and especially those of us whose, parents maybe weren't in the formal saving sector in their lifetime, we don't get to start working life without having to get into debt. And so I guess it's just to understand this debt animal, and more importantly, how to ride it and how to benefit from it, and then how to get it out of your life before it eats you. And so I think in this context, understanding that there may be three kinds of debt. The bulk of us, if we're going to buy our home one day, and we don't do that with cash. Unfortunately, unless you marry rich or you win the lotto, the reality is you're gonna get a bond from a bank and you're going to have debt. And that's okay. I think just to understand, for me, that would be called good debt, because what's happening is you're buying an asset, so you're buying something that over time should grow in price by at least the rate of inflation, hopefully better, but at least by the rate of inflation over a long period of time. So you're not buying something that's going to go backwards in value or actually have no value. And so as long as your bond is affordable and you can carry the costs of the mortgage, the insurances of the house and all the other things that you need to do, then I would say owning your home via debt is a good thing. However, that doesn't mean that you take all 20 years to pay off the bond. You've got to pay it off faster still. Make sure that you don't pay it off at the slowest rate possible. So that can be good debt. And sorry.
No, carry on.
And then I think to make Pavlo happy, you can argue that taking on debt to buy or taking on debt inside your business or taking on debt to buy a business that's going to grow in value over time as well would be good debt. So I think there is an argument for that, where you take on debt to buy income generating assets as well. There are a whole lot of risks and a whole lot of warnings that you need to be careful of just buying on a promise and all of those things. So do your homework, but there is the possibility that that's a good thing to do. So
I love credit cards. I love credit cards. Can we move on to the good stuff? I think credit cards are the most awesome personal finance tool ever invented. Discuss.
So and never a less true word was spoken on live radio anywhere in the world by Bruce Whitfield. The credit card debt is to me a weapon of wealth destruction.
I didn't say debt was good. I said the credit card is a wonderful tool. Do you disagree with the fact that it's a wonderful tool, or are you just so paranoid of the fact that most people struggle to manage that credit that actually it becomes a weapon of financial self-destruction?
So I think it's in a country that, in all honesty, is addicted to debt. to give people an easy way to access even more debt and to spend money at any time, 24 hours a day, on their phone, going out one day when they can go out again, online shopping, all of that. And the credit card, or maybe nowadays the debit card as well, but the credit card in particular is the great facilitator of all of that. And it's amazing that the moment you start working and the bank sees that you're starting to generate some income, they will offer you a credit card, and then they will offer you, I get offers on my app, on my banking app, every now and then saying, just click here if you want to increase your debt. So the answer is that credit cards as a tool may be good for 5 out of every 100 people. For the other 95, it's a weapon of wealth destruction, and you're kind of giving people who are addicted to debt access to even more debt. To me, it's kind of close to financial evil as you can get. And I don't want to be kind of paternalistic about it, but I just think it's one of those things where we should make it hard for people to get credit card debt, and you should get it on a behavior issue. The way you deal with debt, it should be the reason why you're able to take on more, not because you earn more.
You see, now, banks like bad payers because the secrets of credit cards, things like if you don't pay off your balance each and every single month in full, you pay interest on the whole outstanding balance before you paid off a small percentage of it. You're encouraged to pay off just a little bit and to roll the credit over month after month after month. Take as long as you need, as long as the interest payments come in. And I don't know how high they are. I'm sure they're much lower today than they used to be, but still it's one of the most expensive forms of debt that you can get. The banks don't want you to be responsible with the credit. They hate me as a credit card user because I pay it off in full every month. I don't spend too much on it. And the little bit that I do spend, in order that I can participate in a rewards program and get other benefits as well, I like it from that respect. But unless you have self-discipline, credit cards are deadly tools when it comes to money.
I think like we are all supposed to, go through a learning experience and an education experience, and then a test to be able to drive on the roads. Something similar should happen with access to credit cards. We should go through an education exercise, all of us, standardized, not by the banks, where we're taught about this. We're taught about what budget and straight is, and then let's talk about the tool. I agree with you. The 5 out of every 100 people that understand credit cards and manage them incredibly well, they find them incredibly convenient. They don't spend the money on a monthly basis of their own. They use the bank's money. So they essentially go into debt for the 29 days and make sure that they're always paid up and clear. And for them, they're doing incredibly well. But as a social good in our country, I think credit cards are a great evil, I'm afraid to say.
No, I appreciate your perspective on it. And I think that the way in which people use the cards is the problem. And I think that lack of education and the fact that the bank relishes the fact that you are not using this efficiently for your benefit, but for theirs, is deeply problematic. Short-term loans. We hear about the power of microfinance to change lives, and we hear about Grameen Bank in Bangladesh. And we spoke to the guy who founded Grameen Bank, and he remains adamant that, microlending, again, depending on how you use the loan, if you're using your microloan every month to buy clothes and food, then you've got a problem. But if you're using your microloan to educate kids or to fund the starting up of a micro enterprise, well, you're adding value. You're probably, doing the right thing with microfinance. A lot of people get sucked into short-term loans in South Africa, and again, a bit like credit cards, struggle to pay them back.
Exactly right, and I think you hit the nail on the head. It's what you're using it for that really counts. And so, if I wanted to solve South Africa's issue around behavior around these kinds of loans, I would say that you only issue micro loans to stokvels run by women. And the women decide who gets the loan, and they hold each other to account. So when you've got positive social peer pressure, watch how things go. And that was the secret to Grameen Bank, wasn't it? I mean, It wasn't just, issue the loans to anybody. It was actually, it ended up being primarily to women who started micro enterprises. And so I think, history shows us women are far better with money than men. And so, we again, let's use our history as a country. Stokvels is the South African thing, and we should use it, and that would work. But of course, that won't make the banks lots of money, but would be a great way, Minister of Small Business in South Africa, if you're doing your job, if you want to kind of get a tip, here it is. And so that would be a way to start micro enterprises and make the communities responsible for this, because they will manage it and they will self-regulate the bad payers and make sure that they're doing things for the right reasons, spending the money in the right way. For the rest of us, personal loans, overdrafts, microloans, terrible. Another weapon of wealth destruction. Please don't use it to buy things like clothes that have no value the day after you buy them, and don't buy your holiday on credit. All of those things are really awful ways to spend money. You need to borrow money only for something that's going to grow in value, or it's going to help you generate an income. So borrow money to buy a car because you need your car to get a job. Great, but buy a second-hand car. Don't go and buy the most expensive car. Then I think that's good. That's neutral debt at best. And then, as I say, to borrow money to buy a house, by all means, as long as it's affordable. Credit cards, I think we could ban them, and the country would probably be better off.
Sure. Thank you, Warren. I respect your view. Your email from Kim this evening says, Warren, I've got a few investments I manage on my own. My strategy has been to buy funds from a few different managers to make up my portfolio. The logic behind my strategy is to diversify between different investment managers, but I'm not sure how many funds I should have in my portfolio, and I'm worried that I'll make my life complicated in the future. What do you think about the strategy? And is there a way I can make my portfolio easier to manage? We like Kim very much, and we're going to talk to Kim about her strategy in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So Kim has heard Warren often talk about diversification. So Kim has done diversification her way, which is to buy probably too many unit trusts or investment funds managed by multiple asset managers in multiple companies. Is that the diversification that you talk about, Warren?
Not really. And my reason is that if we're talking about, buying South African unit trusts, let's just talk about stock market unit trusts. And they're generally going to be called general equity funds. Now, when you buy a general equity fund, what you're telling the fund manager is you can buy, a range of shares, but you can only buy shares on the JSE, and potentially 30% of the money can be used to buy global shares. Now that's not a bad idea to buy shares. I think it's your best asset class. But the issue is that in South Africa we probably only really have about 80, and that's at a push, 80 shares, more likely 60 shares that large unit trusts can buy that will actually make a material difference to growing their portfolio. The rest of the number of shares on the JSE are just far too small for the unit trusts to buy, or if they do buy them, they can only buy such a small percentage that it actually makes no difference to the portfolio. So if you buy 5 different funds from 5 different fund managers, the likelihood is that you're buying actually a very, very expensive index, because the reality is that one manager will be buying Anglos as a share, and another manager will be saying, hang on, I think Anglos has done too well for too long, I'm going to sell Anglos. So you end up owning Anglos irrespective of the diversification view that you might have, because there are just so few shares available on the JSE for fund managers to buy. So unfortunately, you're actually not getting a lot of diversification if you buy too many general equity funds in South Africa. My view is, if you want diversification, then maybe you buy one general equity fund and you buy the index, the index that tracks the South African stock market, because then you're going to get the performance of the index. Whatever the markets do, you'll get that growth with half your money. And then you're paying one fund manager, to get you performance that looks different to the stock market. And that's the important thing, is you can't go and buy a general equity fund where the fund manager is so timid that actually all they're doing is they're buying 0.5% more of Naspers or 0.5% less of Naspers than the index. That's called index hugging, and they're wasting your time and your money. You've got to pay a fund manager to look completely different to the index, And then if you've got the index as well, you've probably got fairly good diversification within your portfolio. But unfortunately, many funds in South Africa in the same type is false diversification and just becomes monumentally expensive index tracking.
Thank you for that, Warren. I hadn't heard the term index hugging before. I'd never seen fund managers as warm and fuzzy and cuddly, but yeah, I get the point. Then I'd like to know from you a scientific explanation on a term, market sentiment. Today, for example, market sentiment wasn't happy. It wasn't good. It wasn't positive.
And so market sentiment, or otherwise called investor sentiment, is exactly that. You're talking about emotions, as you said. The market wasn't happy, and so what we're talking about here is the general sense that investors as a collective are feeling at the time. So for example, in the current environment, when the stock market's taken a pounding, it's telling you that investors are worried about something. They're fearful about something. And the same would apply when the stock market shoots up, on a particular day, or even over a period of time, 6 months or a year. I mean, investor sentiment can be very negative for a very long period of time, or very positive. But what you're looking at here is psychology, and what's important to note is that it does work very much like the tide. So when the tide is coming in, it's pointless as the small little investor to try and kind of row against the tide. The tide will just wash you in, or if the tide's going out, the tide will wash you out. So to understand the kind of tone of the market, or the sentiment of the market, the way that the market in general is feeling, is valuable to investors just for very short periods of time. So over long periods of time, you can ignore market sentiment. But in the short term, if, for example, you wanted to kind of buy something which maybe is going down in price, it might be important just to understand what the sentiment is around that. If investors in general are really kind of negative about the share that you want to buy, it could be that you're buying it. Let's say it went from $100 to $50, and you decide that that's a great price. I'm going to buy it now. What could happen is you might have caught the falling piano, and what happens is you get crushed because the price goes from $50 to $1, and then you lose most of your money. And so just be careful that when that investor sentiment is really strong and moving the market in a direction, you can't go against that. And then it's better just to let that sentiment wash itself out. And that's what happens in general, that we have these very strong senses of emotion, and they push the markets for a period of time, and then it kind of mutes out, and then you kind of get a better sense of what's going on. And so for investors in general, just to understand, markets can be horribly wrong over the short and medium term. So don't trust in investor sentiment as a very accurate guide of what's going to happen over a decade. All you know is that if investor sentiment is very strong right now, get out the way, let it sort itself out, and then make your investment decision.
Warren Ingram from Galileo Capital. Thanks, Warren.